There is a ruling sitting in the United States Supreme Court record that most Americans have never heard of, and the IRS would very much prefer to keep it that way. It involves your bank account, a specific dollar amount that triggers an automatic federal report, and a legal protection that was hard won in the nation's highest court that you are almost certainly not using. If you have ever deposited a large amount of cash, sold a car privately, received money from your children, moved your own savings from one bank to another, or received an inheritance from a family member who passed, then what I'm about to tell you in the next few minutes could be the most important financial information you hear all year. Here's what keeps most people up at night once they learn about this. It's not the report itself. The report is routine. Millions of them get filed every single year, and the overwhelming majority go absolutely nowhere. What keeps people up at night is what comes next. Because when most retirees, most ordinary Americans find out that their bank is quietly filing federal paperwork about their deposits, their instinct kicks in. And that instinct, the completely natural, completely understandable desire to protect themselves and stay under the radar, is the exact instinct that transforms a perfectly legal financial transaction into a federal criminal investigation. Last year alone, the federal government seized funds from thousands of Americans whose money was 100% legal. Not drug dealers, not money launderers, retired teachers, business owners, widows and widowers consolidating accounts after losing a spouse, people exactly like you. I'm going to make sure you are never one of them. Let's start at the beginning, because to understand the Supreme Court ruling, you first have to understand the rule it was interpreting. Under the Bank Secrecy Act of 1970, every single financial institution operating in the United States, every bank, every credit union, every savings and loan association is required by federal law to file what is called a currency transaction report, or a CTR, anytime a customer makes a cash transaction that exceeds $10,000. That report gets filed on FinCEN Form 104 and goes directly to the Financial Crimes Enforcement Network, known as FinCEN, which is a bureau inside the United States Treasury Department, not the IRS, the Treasury. That distinction matters, and I'll come back to it. The bank files this report, not you. You do not fill out a form. You do not sign anything. You will probably not even be told it happened. The bank has 15 calendar days after the transaction to submit the report electronically, and they are required by law to keep records of it for 5 years. Now, here's what most people don't understand. This happens millions of times every year. Millions. A retiree deposits proceeds from a car sale. A small business owner deposits a week of cash receipts. A grandmother deposits a gift from her children. CTRs get filed on all of them, and the vast majority of those reports result in absolutely nothing. Nobody calls, nobody shows up at your door, nobody freezes your account, nobody opens an investigation. A CTR is not an accusation, it is not an audit trigger, it is not a red flag on your account, it is paperwork. Routine, automatic, boring paperwork that the bank's compliance software generates and sends to a federal database. That's it. But here's where everything goes wrong, and this is the part the IRS and federal prosecutors definitely do not want you to think too carefully about. When most people hear about the $10,000 rule for the first time, they have the same immediate reaction. It's almost universal. They think, well, if $10,000 triggers a report, the obvious solution is to just deposit $9,500 instead. Or they think, I'll break it up, put a little in on Monday, a little more on Thursday, spread it across a few different weeks, problem solved. Right, wrong, catastrophically, life-alteringly wrong. Because that instinct, that seemingly logical thought process has a specific name under federal law. It is called structuring. And under 31 U.S. Code Section 5324, structuring is not a civil violation, it is not a fine, it is not a warning letter, it is a federal crime. It is illegal to structure or to assist in structuring any transaction with a financial institution for the purpose of evading reporting requirements. Read that carefully. The purpose of evading reporting requirements, not the purpose of committing fraud, not the purpose of laundering money, not the purpose of hiding criminal proceeds. If your money is completely clean, every single cent of it legally earned, legally inherited, legally gifted, and you deliberately break it into smaller deposits to avoid crossing the $10,000 threshold, you have committed a federal offense. The penalties are not minor. For violations involving less than $100,000 over a 12-month period, you are looking at up to 5 years in federal prison and fines of up to $250,000. For violations over $100,000 or for cases connected to any other illegal activity, that rises to up to 10 years in prison and fines of up to $500,000. And in both cases, the government has the power to seize the money through civil forfeiture. The money you are trying to protect by breaking it up, the government can take it, all of it. Now here is where the Supreme Court comes in, and this is the part the IRS does not want you to understand because it is the part that protects you. In 1994, the United States Supreme Court decided a case called Ratzlaff versus United States. The defendant, a man named Waldemar Ratzlaff, had broken up cash deposits to avoid the reporting threshold, and the government prosecuted him for structuring. The case went all the way to the point of a court's ruling established a specific and critically important legal standard that applies to every structuring case in this country to this day. The court ruled that to convict someone of structuring, the government must prove two distinct things. First, that the defendant knew about the reporting requirement, meaning they knew that transactions over $10,000 triggered a federal report, and second, that the defendant knew that structuring itself was illegal, not just that breaking up deposits was questionable or potentially suspicious. They must prove that you knew it was against the law. That is an enormous legal protection. The government cannot simply point to the pattern of your deposits and say, look, they obviously knew what they were doing. They have to prove actual knowledge. They have to demonstrate that you understood that structuring was a crime, not just a workaround. Here is the uncomfortable truth that follows from that ruling. If you are watching this video right now, you now know about the $10,000 reporting requirement. It has been explained to you in plain language. And if you go out after watching this and break up a deposit to avoid that threshold, a federal prosecutor will stand in front of a jury and argue using the Ratzlaff standard that you had full knowledge, you watched a video, you were informed, you did it anyway. That is exactly the argument they need to make the charge stick. The Ratzlaff ruling is a shield, but only if you use it correctly. Once you have been informed, the shield becomes a sword pointed back at you if you ignore what you've learned. Now here is the statistic that I find genuinely staggering and that I think everyone in this country should know. The IRS conducted an internal study that found that 91% of all structuring forfeitures involve legally sourced funds. 91%. That means that 9 out of 10 people who had their money seized for structuring were not criminals, they were not drug dealers, they were not running financial schemes, they were ordinary people whose money was completely legitimate, who simply made the mistake of breaking up their deposits because someone told them that was the smart thing to do, or because it seemed like common sense. 9 out of 10. These are your neighbors, these are retirees, these are small business owners who dealt in cash, people who spent their entire lives earning money honestly and then lost it because of a decision that seemed protective but was actually the most dangerous move they could make. But the currency transaction report is only half of the picture. And honestly, it's the less dangerous half. Because there is a second type of report your bank files, and most people have never heard of it at all. It is called a Suspicious Activity Report, or a SAR, and this one has no minimum dollar threshold whatsoever. A CTR is triggered automatically when a single cash transaction exceeds $10,000. There is a clear line, you cross it, a report gets filed. That's mechanical, it's predictable, and as I've explained, it is completely routine. A SAR is different in every way. A bank can file a SAR on a $500 transaction, a $200 transaction. There is no flaw. The bank files a SAR when it observes behavior that looks like someone is trying to avoid detection, trying to circumvent reporting requirements, or engaging in transactions that appear inconsistent with normal account activity. And the software that modern banks use to identify these patterns is extraordinarily sophisticated. This is not a teller looking at your account and making a judgment call. This is machine learning, pattern recognition algorithms processing millions of transactions and flagging behavior based on statistical models built to identify exactly the kind of behavior people think is clever. Here is what that software is designed to catch: a deposit of $9,000 on a Monday, another deposit of $8,500 on a Wednesday, a third deposit of $9,700 the following Monday. The algorithm does not see 3 ordinary deposits from someone who had a busy week. It sees a pattern. It sees 3 deposits in 10 days, all below $10,000, all clustered in a way that looks intentional, and it flags it for review immediately. But here is what makes SARs especially dangerous, and I cannot stress this enough. Under federal law, the bank is prohibited from telling you that a SAR has been filed. It is not just a bank policy. It is a federal crime for a bank employee to inform a customer that a suspicious activity report has been filed on their account. So you could walk out of your bank today after making what you thought was a completely routine deposit, and a SARE could have been filed on your account, and you would have absolutely no way of knowing. You would have no opportunity to explain yourself, to provide documentation, to correct a misunderstanding. The report goes, the investigation begins if it begins, and you are in the dark. CTRs are routine and they are symmetric. Every transaction over $10,000 gets reported. SARs are targeted. They are the result of someone or something at the bank looking at what you're doing and deciding it looks suspicious. And the difference between triggering one versus the other often comes down to a single decision about how you deposit your own money on a single afternoon. I want to walk you through the exact situations where I see people make the wrong call. These are not hypothetical scenarios. These are the real moments, the ordinary, completely understandable moments where ordinary people destroy themselves financially and legally. And I want you to know exactly what to do in each one of them. The first scenario involves selling a car, and it happens thousands of times every day across this country. You sell your vehicle privately for $14,000. The buyer pays in cash, which is perfectly normal and perfectly legal. You take the envelope of cash to your bank, and then the instinct kicks in. You think $14,000 is over the limit. You think, I'll deposit $7,000 today and the rest next week. That decision, that simple, seemingly sensible decision, is structuring. The correct move is simple and requires no strategy whatsoever. You deposit the full $14,000 in one transaction. Before you walk into the bank, you make sure you have a copy of the bill of sale. Your name, the buyer's name, the make and model of the vehicle, the date of the transaction, the amount, and both signatures. When the teller asks, because they are trained to ask about large cash deposits and it is part of their compliance obligation, you answer in one sentence. You say, I sold my car. You hand them the bill of sale. That's it. A CTR gets filed. You go home. Nothing happens. Your records are clean, your story matches the documentation, and there is nothing further to investigate. The second scenario is a cash gift from your children. Your son or daughter gives you $15,000 in cash. Maybe it's for medical expenses, maybe it's for a special occasion, maybe they just want to help. The reason is entirely irrelevant to the tax question. A gift received is not taxable income to you, the recipient, period, full stop. But bad advice is everywhere on this topic, and I've heard it all. Your neighbor tells you to split it across 3 different bank branches. Your friend tells you that cash gifts need to be kept under $10,000 per deposit. Both of those people are trying to help you, and both of them are steering you directly into a structuring violation. Here is what the law actually says. In 2025, any individual can give up to $19,000 per recipient per year with no gift tax reporting requirement whatsoever. If the amount exceeds that annual exclusion, it is the giver, not the recipient, who files a gift tax return. You, the person who received the money, owe nothing, file nothing, and report nothing. Deposit the full amount in one transaction. Have your child write a simple 1-paragraph letter. Their full name, your full name, the amount, the date, and one sentence confirming it is a gift with no expectation of repayment. Keep that letter in a file folder somewhere. If anyone ever asks, you have everything you need. The third scenario is the one that haunts me most because it is the most heartbreaking and the most preventable. Moving your own money between your own accounts, you've seen a better interest rate at a different bank, you're consolidating accounts after a major life change. You just want to simplify your finances. You are not moving anyone else's money. You are not hiding anything. You are not doing anything remotely questionable. You are simply transferring your own legally saved dollars from one place to another. I had a client, a retired school teacher, 69 years old, recently widowed, who was doing exactly this. While she was grieving the loss of her husband of 43 years, she made the decision to close one of their joint bank accounts and move the balance, $23,000, money she had been saving for over 35 years of teaching, to another institution. She was overwhelmed, she was exhausted, she didn't want to deal with a large wire transfer while her world was collapsing around her, so she moved it in pieces. A few $1,000s at a time over several weeks, just to make it more manageable emotionally. She wasn't hiding anything, she wasn't avoiding anything. She just couldn't face one more large, complicated task in the middle of her grief. 6 weeks after her first deposit, she got a letter. The bank's pattern recognition software had flagged her account. It didn't know her husband had just died. It didn't know she'd spent her career teaching children to read. It saw a pattern of repeated deposits under $10,000 over a period of weeks, exactly what it was designed to flag. A suspicious activity report was filed. She was eventually cleared, but the process took months. The legal fees were significant. And the anxiety of being under federal scrutiny, layered on top of the grief she was already carrying, was devastating. None of it needed to happen. If you are ever moving your own savings, move the full amount in one transaction. Keep bank statements from both accounts. Keep the transfer confirmation. One clean move documented from both ends tells a complete and unambiguous story. The fourth scenario is an inheritance. A family member passes away and leaves you a portion of their estate, let's say $40,000. The executor writes you a check or in some cases hands you cash from a safe or safe deposit box. There is no federal inheritance tax for the vast majority of Americans. The federal estate tax exemption currently sits above $13 million, and unless your relative was extraordinarily wealthy, you owe nothing to the federal government on this inheritance. But if you receive that money in cash and begin depositing it in installments across multiple weeks, the bank does not see an inheritance. The bank does not see a grieving relative who received a gift from someone they loved. The bank sees a pattern of deposits structured to stay under the reporting threshold. The solution is exactly the same as every other scenario. Deposit the full amount in a single transaction. Keep a copy of the will, the estate settlement letter, or the executor's documentation showing that you are a named beneficiary and this is your distribution. That paperwork is your complete defense. It answers every question before it is asked. The fifth scenario surprises people because it involves money the government itself is sending you. If you delayed filing for Social Security, as many financially savvy retirees do to maximize their eventual monthly benefit, you may receive a retroactive lump sum payment covering up to 6 months of back benefits. Depending on your benefit amount, that payment can easily exceed $10,000, sometimes significantly. When that money arrives in your account, a CTR is filed. That is completely fine. It's routine. But what sometimes happens is that a retiree sees a large government deposit appear, gets nervous about the size of it, and starts moving money around to different accounts in smaller amounts. That behavior, even with Social Security money, even with money that has a perfect paper trail going back to the federal government itself, can trigger a suspicious activity report. Leave it alone. The Social Security Administration has a complete record of every payment it has made to you. Your bank has a record of the deposit. The documentation exists automatically, independently, and completely. There is no possible reason to touch that money in a way that creates a pattern. Don't manufacture a problem where none exists. Now, I want to address something that caused an enormous amount of confusion a few years ago, and that I still get questions about constantly. You may have heard about a proposed $600 reporting rule. It generated genuine panic when it was first floated, and there's still a significant amount of misinformation circulating about it. Here is the complete, accurate picture. In 2021, during the legislative debate over the Build Back Better Act, there was a proposal to dramatically lower the reporting threshold for certain digital payment processors, platforms like Venmo, PayPal, Cash App, and Zelle, from $20,000 down to $600. This was a proposal about 1,099K reporting for third-party payment platforms, not about bank cash deposit reporting. The Build Back Better Act never became law. It died in the Senate in December of 2021. The Inflation Reduction Act that eventually passed in 2022 did not include any of those threshold changes. The $10,000 CTR threshold for cash deposits at financial institutions remains exactly where it has been since the Bank Secrecy Act was signed in 1970, unchanged. There is currently a bill called the Streamline Act introduced in late 2025 that would raise the CTR threshold from $10,000 to $30,000 and adjust it for inflation every 5 years. As of today, that bill has not passed, but it tells you something important about the direction of this conversation. Nobody in Congress is seriously proposing to lower these thresholds. The movement is in the other direction entirely. Let me talk about what actually happens at the bank window when you make a large deposit. Because this is where I see retirees make their second most damaging mistake, right after the structuring mistake itself. When a teller asks you about a large cash deposit, they are doing their job. They are trained to ask. It is part of their compliance obligation. The right response is brief, honest, and done. I sold my car. It's a gift from my daughter. I'm closing an account at another bank. One sentence. You hand them whatever documentation you have. Then you stop talking. What you must absolutely never do is volunteer additional information beyond what was asked. You don't explain your entire financial history. You don't apologize for the amount. You don't say anything that includes the words, "I want to avoid being reported," or "Is this going to trigger something?" Those exact phrases, if they make their way into a suspicious activity report narrative, become evidence of intent. You also never, under any circumstances, agree to restructure the deposit. If a teller trying to be helpful says, "Would you like to split this up?" the answer is no, a firm, polite, unambiguous no, every time. And if you ever receive a letter or a phone call from a federal agency, from FinCEN, from the IRS, from the Department of Justice, anyone contacting you about your banking activity, there are 5 words you say before you say anything else. "I'd like to contact my attorney," not "let me explain," not "I didn't do anything wrong," not "can I show you my records?" You say 5 words and you stop. That is your right. It is guaranteed to you, and it is the single most important thing you can do in that moment. Then you find a tax attorney or a criminal defense attorney with specific experience in financial crimes. You do it before you say another word to anyone. The principle underneath all of this is the same in every scenario, and it never changes. The report is not the crime. The crime is trying to avoid the report. The $10,000 threshold is not a trap designed to catch honest people. It is a tool the government uses to detect money laundering, fraud, and financial crime at scale. But the system is not capable of distinguishing between a drug dealer structuring cash transactions and a retired school teacher who got bad advice from her neighbor about how to move her own money. The algorithm sees patterns. It does not see people, which means the only way to protect yourself is to make sure your patterns are clean, your records tell the whole story, and you never give the system a reason to look more closely. Here is the practical action I recommend that literally takes 5 minutes and protects you for the rest of your life. Create a folder. Physical, digital, it doesn't matter. Whatever you're comfortable maintaining, label it transaction records. Every time you make a deposit above a few $1,000s, put 4 things in that folder. First, a 1-sentence note describing the source of the money and the date. Received $14,000 from the private sale of a 2019 Honda Accord to John Smith on March 5, 2026. Dated, signed by you, 1 sentence. Second, your supporting documentation. A bill of sale, a gift letter, an estate settlement document, a Social Security award letter, bank statements from the originating account, whatever proves where the money came from. Third, your bank statement showing the deposit. And fourth, if you moved money between accounts, the transfer confirmation from both sides. That folder is your complete defense if anyone ever questions a deposit from 3 years ago. You will almost certainly never need it. The odds that any individual CTR ever leads to anything are extremely small. But if you ever do need it, if someone ever asks, if you ever get a letter, that 5-minute folder becomes invaluable. There is no age exemption from these laws. There is no retirement exemption. There is no good citizen exemption. The law applies to everyone equally. But the people who understand these rules, who keep their paperwork clean, who deposit their money in full and let the routine reports be routine, those people never have to worry about any of this. They sleep well at night. I've seen too many good people, honest people, who worked their entire lives and saved carefully and did everything right, get caught in situations they never saw coming because nobody told them the rules in advance. That is what this is for. If you know someone who handles large amounts of cash, a parent, a spouse, a sibling, a neighbor, a friend, send them this. 20 minutes of information now could save them years of stress, tens of thousands of dollars in legal fees, and the kind of anxiety that no one who has worked their whole life deserves to carry. And if you've ever deposited more than $10,000, if a teller has ever asked you questions about a large cash transaction, I want to hear about it. Drop your experience in the comments. I read every single one, and the most common situations become future videos.